What if a single, unelected entity, operating from a quiet district in Tokyo, came to own assets worth more than its country's entire annual economic output? What if this institution held over half of all government debt, effectively becoming its own government's primary creditor? And what if it was also the single largest owner of the nation's stock market, a top 10 shareholder in nearly 90% of its most iconic, publicly traded companies? This isn't the plot of a dystopian novel. This is the reality of the Bank of Japan. For 3 decades, the world's third largest economy has been the subject of the largest and most audacious financial experiment in modern history. It is a story born from a crisis that brought a global powerhouse to its knees, a story of a desperate war against an invisible economic enemy, and a story that has culminated in the creation of a financial leviathan with a balance sheet so colossal it defies comprehension. At its peak, the Bank of Japan's assets exceeded 750 trillion yen, or roughly $5 trillion, a sum greater than the entire gross domestic product of Japan itself. This is more than just an academic curiosity. It is a journey into the uncharted territory of monetary policy, pushing the boundaries of what a central bank is and what it can do. It raises fundamental questions that resonate far beyond Tokyo. How did one of the world's most historically conservative institutions become its most radical economic gambler? What happens when a central bank stops merely influencing the market and becomes the market? And, most critically, how does this unprecedented experiment end without triggering a domestic and potentially global financial cataclysm? This is the story of the central bank that owns a country and the perilous dilemma it now faces. To understand how the Bank of Japan, BOJ, became the world's greatest financial outlier, one must first understand the sickness it was created to fight. It was a sickness born in the ashes of an economic miracle, a malady that would grip the nation for a generation and rewrite the rules of modern economics. This was the era of Japan's lost decades. In the 1980s, Japan was an economic juggernaut, the envy of the world. Its manufacturing prowess was legendary, its brands dominated global markets, and its rise seemed unstoppable. This confidence fueled one of the most spectacular asset price bubbles in history. In Tokyo, the Imperial Palace grounds were famously said to be worth more than all the real estate in California. The stock market, the Nikkei 225, seemed to know only one direction: up. Then, the music stopped. On the final trading day of the 1980s, December 29, 1989, the Nikkei 225 hit its all-time intraday high of 38,957. It would not see that level again for over 3 decades. The collapse was swift and brutal. In 1990 alone, the market lost nearly 40% of its value. But this was just the beginning. The slow, grinding crash continued for years, eventually bottoming out in 2008 at over 80% below its peak. The real estate market followed a similar, agonizing trajectory. Land prices, which had peaked a year after the stock market, began a relentless decline that would last for over a decade, ultimately wiping out an astonishing 70% of their value by 2001. Trillions of dollars in paper wealth evaporated, leaving a landscape of financial ruin. Banks, which had lent recklessly against the collateral of ever-rising stock and land prices, were suddenly saddled with mountains of non-performing loans. The engine of Japan's post-war miracle had seized, and the country was plunged into a profound economic and psychological trauma that would set the stage for the radical experiments to come. The bursting of the bubble unleashed a more insidious and persistent enemy: deflation. Deflation is the opposite of inflation. It is a sustained fall in the general price level. While falling prices might sound appealing, for an economy, it is a devastating disease. It functions like economic quicksand. The more an economy struggles against it, the deeper it sinks. When prices are consistently falling, a corrosive psychology takes hold. Consumers delay purchases, asking themselves, why buy today what will be cheaper tomorrow? This collapse in demand forces businesses to cut prices further, shrinking their profits. To survive, they slash investment in new equipment and research, and most critically, they cut or freeze wages. This, in turn, reduces household income, further depressing demand and creating a vicious, self-reinforcing downward spiral. This deflationary mindset became deeply entrenched in Japan. For over a decade, the country was trapped in this economic ice age. GDP growth stagnated, averaging a mere 1.14% annually from 1991 to 2003, a fraction of its previous performance and well below other industrialized nations. Real wages fell, an unprecedented phenomenon in a modern developed economy, dropping by around 13% from their peak in 1997 to 2013. This period became known as the Shushoku Hyogaki, or Employment Ice Age, as companies drastically cut back on hiring new graduates, leaving a generation of young people facing a barren job market and diminished future prospects. The economic sickness was, in part, a deliberate choice to avoid a social catastrophe. The Japanese system of lifetime employment and the intricate, close-knit relationships between banks and corporations meant that allowing widespread bankruptcies, the creative destruction that economist Joseph Schumpeter saw as essential to capitalism, would have triggered a massive social upheaval. To prevent mass unemployment and maintain social stability, banks, often with the tacit approval of regulators, chose to evergreen loans to failing companies, rolling over debt and extending credit to firms that were functionally insolvent. This created a generation of zombie firms, unproductive companies kept alive by cheap credit that clogged the arteries of the economy, absorbing capital and labor that could have been deployed to more innovative and productive ventures. Japan traded decades of dynamic growth for a long, painful period of stagnation, a choice that would have profound consequences for the policies that followed. Faced with this unprecedented challenge, the Bank of Japan's initial response was tragically inadequate. Steeped in a post-war institutional identity built around fighting inflation and maintaining financial prudence, the central bank was fundamentally unprepared for the opposite problem. Its entire institutional muscle memory was wrong. This paralysis was evident in its early policy moves. Even as the stock market was collapsing in 1990, the BOJ, still concerned about the lingering heat in the real estate market and potential inflation, actually raised its discount rate, tightening monetary policy at the worst possible moment. When it finally reversed course and began cutting rates in mid-1991, the response was too slow and too timid. By the time the BOJ lowered its policy rate to near zero in 1999, the deflationary mindset had become a deeply ingrained feature of the Japanese economy. This initial failure was crucial. It demonstrated that conventional monetary policy, simply adjusting short-term interest rates, was powerless. The economy had fallen into what John Maynard Keynes termed a liquidity trap. With interest rates at zero, the central bank could no longer stimulate the economy by making money cheaper. It could pump liquidity into the banking system, but if no one wanted to borrow, that money would simply sit idle. The BOJ's conventional toolkit was empty. The failure of this orthodox approach created a policy vacuum, forcing the central bank to abandon its conservative identity and venture into the unknown, planting the seeds for the radicalism that would define the next quarter century. By the turn of the millennium, the Bank of Japan was facing a crisis of both economics and imagination. With interest rates at zero and deflation still entrenched, it was forced to write a new playbook. What followed was a series of escalating interventions, each more audacious than the last, as the BOJ progressively moved from being a participant in the market to a manipulator of the market, to the market's ultimate dictator. The first great leap into the unknown came in March 2001, when the Bank of Japan became the first major central bank in modern history to implement a policy of quantitative easing, or QE. The logic was simple. If lowering the price of money to zero doesn't work, you increase its quantity. In practice, QE involved the central bank creating new money, digitally, with a keystroke, and using it to buy large quantities of assets, primarily Japanese government bonds, JGBs, from commercial banks. This had a twofold objective. First, it flooded the banking system with excess liquidity, or cash reserves, with the hope that banks would be encouraged to lend this money out to businesses and consumers, stimulating investment and spending. Second, by becoming a massive buyer of government bonds, the BOJ aimed to push down long-term interest rates, making it cheaper for companies and households to borrow for longer periods. It was a direct injection of monetary adrenaline into the heart of the financial system. For a decade, the BOJ's QE program plodded along with modest effects. Then came the shock. In April 2013, newly appointed Governor Haruhiko Kuroda, as part of Prime Minister Shinzo Abe's ambitious Abenomics reform program, unleashed what became known as the Kuroda Bazooka. This was quantitative and qualitative easing, QQE, a policy that was not just a bigger version of QE, but a fundamentally different beast. The quantitative part was staggering in its scale. The BOJ pledged to double Japan's monetary base in 2 years by purchasing 60 to 70 trillion yen worth of assets annually. But the true revolution was in the qualitative aspect. For the first time, the BOJ declared it would not just buy safe government bonds, but also riskier private sector assets. It began purchasing massive quantities of exchange-traded funds, ETFs, which are funds that track stock market indices, and Japan Real Estate Investment Trusts, J-REITs. This was a momentous step. A major central bank was now directly intervening in the stock and property markets, not to bail out a failing institution, but as a core plank of its monetary policy. The goal was to lower risk premiums, encourage investors to move into riskier assets, and generate a wealth effect that would spur spending. This was the moment the Bank of Japan transformed itself from a lender of last resort into an investor of first resort. The policy was designed not just to alter financial conditions, but to deliver a powerful psychological shock, a signal to the nation and the world that the BOJ was irrevocably committed to ending deflation, no matter what it took. The final evolution in the BOJ's arsenal of unconventional weapons was deployed in September 2016, Yield Curve Control, YCC. With this move, the BOJ shifted its primary target. Instead of targeting the quantity of bonds it bought each month, it began to target the price, or more specifically, the yield, of the 10-year Japanese government bond, pledging to keep it pinned around 0%. To achieve this, the BOJ made a powerful commitment. It would buy an unlimited amount of 10-year JGBs to prevent their yield from rising above its target. This proved to be a more efficient and potent tool than pure QE. The credible threat of unlimited purchases was often enough to keep yields in line, meaning the BOJ could achieve its goal while buying fewer bonds than under the previous QQE regime. It was the ultimate assertion of control. The BOJ was no longer just a large player in the bond market. It was now the market's price setter. This journey, from QE to QQE to YCC, marked a profound transformation. It was the story of a central bank, pushed by desperation, that progressively abandoned the pretense of operating through market mechanisms and instead opted for direct, overwhelming control of asset prices. The cumulative effect of these decades-long escalating interventions was the creation of a balance sheet of unprecedented size and composition. The Bank of Japan mutated from a central bank into something else entirely, the dominant owner of its nation's debt and equity markets. It became a financial leviathan, its tentacles wrapped around the entire Japanese economy. Through its relentless quantitative easing and yen credit control programs, the BOJ became the undisputed master of the Japanese government bond market. At its peak, the central bank's holdings surged to over 53% of all outstanding JGBs. This complete dominance had profound consequences. The JGB market, once one of the world's deepest and most important markets for gauging economic health and risk appetite, effectively ceased to function as a true market. With the largest buyer in the market committed to purchasing unlimited quantities at a predetermined price, the natural process of price discovery was shattered. JGB yields no longer reflected market expectations for growth, inflation, or government creditworthiness. They simply reflected the BOJ's policy target. This market distortion allowed the Japanese government to finance its operations at artificially low interest rates, enabling it to accumulate the largest public debt to GDP ratio in the developed world, standing at over 260%. The central bank had effectively become the government's enabler, monetizing its debt on a scale never before seen in a major economy. Even more radical was the BOJ's foray into the stock market. Through its QQE program of ETF purchases, the central bank quietly became the single largest owner of Japanese equities, surpassing even the country's colossal government pension investment fund. Its influence is pervasive. By 2017, the BOJ was a top 10 shareholder in an estimated 90% of the companies listed on the Nikkei 225, Japan's premier stock index. The scale of its holdings in individual iconic Japanese companies is staggering. It holds over 25% of the shares in Advantest, a major manufacturer of semiconductor testing equipment. It owns over 20% of TDK, the electronic components giant, and a similar stake in Fast Retailing, the parent company of the global fashion brand Uniqlo. From soy sauce maker Kikkoman to musical instrument manufacturer Yamaha, the central bank's presence as a major shareholder is felt across the corporate landscape. At its peak, the BOJ owned approximately 7% of the entire market capitalization of the Tokyo Stock Exchange, holding ETFs with a market value well over 50 trillion yen, or roughly $400 billion. This de facto nationalization of the stock market created its own set of distortions. The BOJ's purchasing program was not based on corporate fundamentals, but on tracking broad market indices like the Nikkei 225 and the Topix. This meant its buying was indiscriminate, propping up the share prices of both well-run and poorly run companies alike. Furthermore, the market quickly learned the BOJ's buying pattern. It often stepped in to purchase ETFs on days when the market had fallen during the morning trading session. This created a predictable backstop, an implicit guarantee from the central bank that it would not let the market fall too far. This so-called BOJ put created a significant moral hazard, dampening volatility, distorting risk assessment, and potentially inflating asset prices beyond their fundamental value. This massive ownership stake created a bizarre paradox at the heart of corporate Japan. The BOJ became the largest shareholder in the country, but it was a silent one. Unlike typical large investors, the central bank does not exercise its voting rights or engage with corporate management to push for better performance, improved capital efficiency, or governance reforms. The ETFs purchased by the BOJ are managed by private asset management firms, which are the entities that technically hold the underlying shares and exercise the voting rights. While the BOJ's policy was explicitly aimed at revitalizing corporate Japan and encouraging more productive investment, its passive, hands-off approach as an owner may have had the opposite effect. By providing a floor for share prices without demanding better performance, it may have entrenched underperforming management teams and undermined the very corporate governance reforms that Japan has been trying to implement to improve its long-term growth prospects. The central bank's solution to corporate stagnation may have inadvertently become part of the problem. For years, the Bank of Japan's radical policies were presented as a temporary cure for an acute illness. But the cure has had profound side effects, and the patient has become dependent on the medicine. Now, as the central bank contemplates an exit, it finds itself in a trap of its own making, a monetary Hotel California, where it can check out any time it likes, but it can never leave. The dilemma is no longer just about stimulating the economy. It's about how to unwind the world's largest financial experiment without detonating it. One of the most damaging long-term consequences of 2 decades of ultra-loose monetary policy has been the proliferation of zombie companies. The endless supply of cheap credit, facilitated by QE and cemented by YCC, kept borrowing costs at near zero levels for years. This allowed unproductive, inefficient firms that would have failed in a normal market environment to stay alive, surviving on a drip feed of cheap debt. This phenomenon prevented the natural process of creative destruction, which is vital for a healthy, dynamic economy. Capital and labor remained trapped in stagnant, low-productivity firms instead of being reallocated to innovative new ventures. While this policy suppressed unemployment in the short term, it came at the cost of long-term productivity growth and economic dynamism. The medicine kept the patient's heart beating, but prevented them from ever truly recovering and regaining their strength. As of 2022, an estimated 251,000 firms in Japan, or over 17% of the total, were classified as zombies. The core of the exit dilemma is brutally simple. The Bank of Japan cannot sell its massive asset holdings without triggering the very market crash it has spent decades trying to prevent. Consider its holdings of Japanese government bonds. If the BOJ were to begin selling its JGBs in significant quantities, or even just stop buying them, the largest source of demand would vanish from the market. Yields would skyrocket, dramatically increasing the Japanese government's borrowing costs. With a public debt level already the highest in the developed world, such a spike could precipitate a sovereign debt crisis, shaking confidence in the country's fiscal solvency. The situation in the stock market is even more perilous. The BOJ is the market's largest single owner. If it were to start selling its massive ETF portfolio, it would transform from the biggest buyer into the biggest seller. The BOJ put, that has supported the market for a decade, would become a BOJ call, creating immense and sustained downward pressure on share prices. The potential for a market collapse is so significant that some estimates suggest that if the BOJ were to sell its ETFs at the same pace it previously sold its smaller holdings of individual bank stocks, the process would take over 200 years to complete. This isn't just a financial problem, it is a deeply political one. The BOJ's policies have created powerful constituencies, a government accustomed to cheap financing, corporations benefiting from inflated stock prices, and investors shielded from downside risk, that have a vested interest in maintaining the status quo. Any attempt to normalize policy and inflict the necessary pain of higher interest rates and lower asset prices will face immense political resistance, functionally constraining the central bank's vaunted independence. The BOJ's dilemma extends far beyond Japan's borders, posing a systemic risk to the entire global financial system. For decades, Japan's near-zero interest rates have fueled the yen carry trade. Global investors, from hedge funds to large pension funds, have borrowed trillions of yen at virtually no cost and invested that money in higher-yielding assets abroad, such as US Treasury bonds, Australian sovereign debt, or European corporate bonds. This has made Japan the world's largest creditor nation, with its investors holding over $3 trillion in foreign assets. A rapid normalization of BOJ policy would violently unwind this trade. As Japanese interest rates rise, the yen would likely strengthen significantly. Investors who had borrowed in yen would see the value of their liabilities surge, forcing them to sell their foreign assets en masse to buy yen and repay their loans. This would trigger a global dash for yen, pulling trillions of dollars of liquidity out of markets around the world. The sudden sale of US Treasuries, Australian bonds, and other assets could cause a spike in global borrowing costs and a sharp downturn in asset prices, potentially igniting a financial crisis that would dwarf the turmoil seen in 2008. The world has become addicted to cheap Japanese money, and the withdrawal symptoms could be severe.